And another thing is that if you are trading between two cryptocurrency, so it must be from the same blockchain, all right? And if there is a different blockchain, like if you want to trade a coin uh, with a coin which is in a different blockchain, so for that we use blockchain bridges, so which is a different topic and a vast topic now. So what is decentralized exchange? Why is it called decentralized exchanges? Because in this exchange there is no central authority, right? So at the central authority is a piece of code, okay, which is a smart contract which looks after the authenticity of the code, authenticity of the trade as well. And if you are actually trading, so your money actually the smart contract stores it for a while, and then when a trade is met, okay, so the smart contracts give the particular coins to each everybody in the trade. All right, so this is how a decentralized exchange works. It has no central authority but a smart contract at the middle. So yeah, a piece of code is more reliable than a human, right? So that's why. So it works in two different methods, right? So the first method is order book method, and second is automated market maker method, okay? So let's discuss what are these methods. So you must be knowing order book method, by the way, if you're into like trading. So you must have heard of WazirX, and even in the US stock market, order book method is used. So it is a widely used method. What it does is that if you have to trade, okay, so you have to put an order of this much trade, and then you have to wait for the seller. Okay, if you are buying a coin, like if you're buying a crypto, so you have to wait for the seller to actually sell the same amount of crypto that you're trying to buy. Okay, and when the needs are met from both parties, so the deal actually works. And so the disadvantage of order book method is that you have to wait actually for the seller or buy, like you have to find a perfect match for your trade. All right, so this is the disadvantage of order book method. So for this disadvantage to be eradicated, we use AMM method, which is automated market maker method. So what it does is that it is first of all used in many dexes, okay? So in this trade, actually there is a liquidity pool. So if a trader comes, okay, so he has to trade in a liquidity pool which has the assets he wants, okay? So if he wants like USDC and Ethereum trade, so both the assets are in that liquidity pool, all right? So if you have to trade, then suppose the USDT and Ethereum are in that liquidity pool. So if you try to buy USDC, okay, so since you're buying USDC, so the USDC price increases, and when you're actually like USDC price increases because you're buying it, and you're getting Ethereum, right? So yeah, so Ethereum price decreases for that, because so when you're buying a crypto, the particular coin price increases, and when you're selling it, so the particular coin price decreases. So this is how yeah, you must be wondering now, like what is a liquidity pool, okay? So what does it mean? Yeah, so that's why I have another slide for you, right? So it is liquidity pool. So what is liquidity pool? It must sound like it's a pool of money, it's a vault. No, it's nothing like that. It's actually a smart contract which looks after this whole process, okay? So what a liquidity pool does is that suppose you have to trade between USDC and Ethereum, right? So uh, if you buy like USDC, the price of USDC increases because we use a formula in liquidity pool, which is X into Y is equals to K, which is a constant. Okay, so we have to maintain this formula all through the liquidity pool. Okay, so what happens here is like you can see this graph. Okay, so even if you buy a lot of USDC, right? Okay, if you have to buy Ethereum, right? So you have to give a lot of USDC. So when you give USDC and you get Ethereum, right? So the Ethereum value decreases in the liquidity pool. So since the value of Ethereum decreases, its price increases. By value I means quantity, okay? So yeah, the liquidity pool never goes empty because of this formula, because you can see this graph, it's actually an exponential graph, okay? So it never actually meets the origin. So this is the magic behind liquidity pool. So even if you buy a lot of no you have to like, if there is a very low amount of Ethereum, right, and you have to still buy Ethereum, okay? in the liquidity from the liquidity pool. Okay, so it will actually ask you for an infinitely large USDC amount, so you cannot pay. So that is the model. That is how liquidity pool works. Okay, so for a liquidity, you must be knowing about liquidity provider. Okay, so who makes this liquidity pool is actually a liquidity provider. What he does is that he comes with two assets. Suppose for now instance, he comes with two assets, USDC and Ethereum. So he makes a liquidity pool. Now he's a liquidity provider. He starts with a 50:50 ratio, and then when the liquidity pool is made, traders come and trade. They make a lot of trades in a day, in a year, and after that the price actually comes, like you can determine the price, huh? So uh, I cannot actually give you the example because I'm running out of time. So yeah, you can understand what liquidity pool is right now.
Yeah, I
Yeah,
think
so
you're already out of time. If you can hurry up, it'll be great.
all right, yeah. So balancer. So balancer, what does balancer is like a Ethereum, like it's a protocol which actually has many benefits because it is better and different than DEX and swaps, other swaps like Uniswap and SushiSwap. So let me just quickly elaborate what is multi-asset pools. So multi-asset pools is like in Balancer, you can actually make a pool of up to 8 assets. Okay, so now apart from having two assets in a liquidity pool, now you can have up to 8 assets. This is helpful because when you have to trade between two basic essential tokens, right? So you have to go through two swaps, which is actually known as routing. Okay, in normal swaps like Uniswap and SushiSwap, but due to multi-asset pools, you can actually trade between two basic essential tokens from the same liquidity pool. Okay, now what is a portfolio manager? Portfolio manager is like you can actually have a portfolio of your assets. Okay, you can make a liquidity pool of your assets, and then since you are using that money, okay, you get a little fees. If people come to trade into your liquidity pool, okay, you get a little fees for that, and your assets are actually getting balanced there as well. So you don't have to do anything otherwise making a liquidity pool. All right, so this is how portfolio manager works. And what are custom ratios? Okay, so custom ratios is that you can actually give like in normal swaps you actually give 50 to 50 ratio. Okay, in curve finance, if you have three assets in the liquidity pool, then you give 33.33 is to 33.33 and is to 33.33. So not like this. In balancer, you can actually have custom ratios like if you have four assets, then you can make 10, 10, 10, and 70 like this, and you can make a ratio according to you. And what liquidity bootstrapping pool is like, if you have a new project, okay, so you can make a liquidity pool with that, and you have a new project, you can make a liquidity pool with it, and for this you have to actually have a high trustable token as well. Okay, like Ethereum. So if you have your project token and your Ethereum token in the same liquidity pool, then you have to give a 90 ratio to that basic that project token, new project token, and a 10 ratio to the Ethereum token. All right, so and soon when you also have to specify time, and when the 50 to 50 ratio is met, then you get to know that what where your project token stands. Okay,
Hey,
now
sorry, Venkatesh, let's kind of stop
yeah, let's kind of stop. Okay,
over limit.
all right,
I gave you too much time, but yeah, let's
all right,
let's kind of
I can understand.
sure everybody sticks to the 5 minute time limit, so that we also have time for people to ask
Yeah,
questions.
yeah.
Um, but yeah, do you? Um, so anybody has any question? Or let's move to the next slide, and then I think let's move to the next slide. Anybody? I think I saw Faisal also have joined. Faisal, do you wanna go? Is he here? I don't know. No.
So
No.
can I stop presenting now?
Yeah, yeah, yeah.
uh,
So, Abhishek, do you wanna go ahead?
Hey Shlok,
Hey,
sorry for joining a bit late. What presentations I missed?
so just one. We started a little late, and then, um, yeah, we just
I have seen the balancer one. What was before that?
nothing. We started a little.
Okay, cool, cool. Thanks.
Abhishek, do you? Yes, you also not there. Kundan, do you wanna?
Can I go?
Yeah,
Safar?
sure. Otherwise,
Okay,
yeah, go ahead. Sure.
okay. So I'll just share my screen. Yeah. Okay, so I'll just keep this very short and sweet. The contract that I was assigned was essentially Nexus Mutual. So Nexus Mutual essentially is an insurance provider, so to speak, for any kind of smart contracts that come up. Basically, this was created in lieu of a hack that occurred, and the founder of this particular project was someone who is a stalwart of the insurance industry. So they figured that it is important to make sure that all the smart contracts that exist out in the wild should be safe against hacks. So that was kind of the idea behind creation of Nexus Mutual. Let's move on to like how it works basically. So Nexus Mutual is essentially all the members who are involved in this protocol put their funds together so that they like mutually share any kind of risk that comes with their tokens. Basically, let's say like there are 10 people who have staked money in the Nexus Mutual smart contract. Then in case any one of them suffers any kind of loss, this pooled money kind of allows all of them to mitigate, kind of get over any kind of loss that they've faced. So yeah, it's essentially a risk sharing pool for which allows anyone to purchase insurance cover. uh, yeah, so here I've also like just have a flow chart which is directly borrowed from the Nexus Mutual website, wherein let's say in case anybody faces any issue, they put a claim submission, and now this claim submission is kind of polled by all of the members who own Nexus Mutual tokens. So the Nexus Mutual token kind of indicates that they are members basically, and anyone who possesses Nexus Mutual tokens has votes. So in case any claim comes in, they vote on whether they should liquidate tokens and provide compensation. In case there's majority, then the outcome is approved. If there is no majority, then they escalate it to all of the members. And in case all of the members then there's again the majority vote is taken as to whether the claim should be processed or not. Now, yeah, this is exactly how it works, wherein members of the mutual have NXM token basically, and they own all of the surplus that comes up when any person buys a particular insurance. So let's say I want to buy insurance. I am provided an NXM token, which allows me to, which is basically indicates that which holds all of the value that is there in the smart contract. Now, this smart contract is kind of priced in such a way that all of the money that has been staked can compensate for all of the losses that may come up in the claims. And the way that they keep the price constant is basically whenever the mutual has excessive funds according to what cover they're supposed to provide, the NXM price increases so that you can sell your token for Ethereum. And when the mutual fund needs more funds, the NXM price decreases to encourage more people to buy into the protocol. So that is how they ensure that the price remains dynamic. Now, yeah, some of the benefits of this protocol is basically that this is completely based on consensus, wherein firstly a pool of people vote on consensus, and in case no majority is reached, then all of the people in the protocol kind of vote for a particular claim, which allows to really democratize the process and remove third-party actors. Basically, there are a lot of cases where people are not provided insurance wrongfully, so this kind of eliminates that. It also reduces the conflict of interest because there is no benefit in not providing out claims basically, because then the price of the mutual will keep increasing, and it's just a never ending cycle of like you're essentially getting the same amount of money that you've put in, so there is no benefit in that. And yeah, they also offer smart contract cover, which is like basically they want to prevent hacks from taking advantage of all of the money that is present in smart contracts. So there's a funny story actually. They started by providing like earthquake cover, which is actually one of the things that I believe they should be adding into their product offerings, because you want to provide insurance against tangible physical products as well. Otherwise, it's very difficult for an insurance company to grow. But yeah, they did start with that, but they realized that people who usually buy into smart contracts are crypto natives, and there's a very small overlap between people who want earthquake cover and people who know how crypto works basically. So that is kind of the reason why they shifted over to providing insurance to smart contracts. So yeah, that's pretty much it. If
Awesome.
anybody has any questions, I guess we can move to that.
Thanks a lot, Safal.
Yeah.
Anybody? Or we can move on.
Sure. Can
Yeah.
I go next?
Yeah.
Yeah.
Sure.
Yeah, sure.
Thanks.
What was that? I'm
No,
sorry.
is there any question for Safar? Sorry.
No, I don't think there are. You want to go ahead, Tanshu?
Yeah, sure. If there's no question, then I would love to go ahead. Yeah.
Yeah, sure.
Oh, okay. I'm sorry. I thought you had it. I'm sorry. I'm sorry. Yeah, sure. Shlok, it's over to you, I guess.
Yeah,
You
yeah, yeah.
can.
Perfect. Nitanshu, can you go ahead?
Yeah. So is my screen visible?
Yeah.
So basically, I was gonna start presenting about the Open. So Open is basically a first DeFi options trading platform. So first, let's have a head start over what actually options are, and then we will move on to know how Open implements options. So basically, options are financial derivatives that give buyer the right but not the obligation to buy or sell any underlying asset at an agreed or strike price before a given date. So basically, option contracts in itself doesn't hold any values, but they derive their values based upon a particular underlying assets. And there are basically two type of option available in the market. With one is call option and another is put option. The call option is basically an option contract which gives the owner the right but not the obligation to buy a particular underlying asset at a given specified price and within a specified time. Basically, it's giving a right but not the obligation. This statement to be considered. And another option we have into the play is put option. The put option gave holder the option to write, but not the obligation to sell a specified amount of underlying security at a specified price within a specified time. So basically, it's just a reverse of call option, but for selling purposes, we utilize the put option. So let's move on to the next slide. So now let's do some permutations or combination of what type of trade possible with option contracts. So basically, we usually call buy as long in the financial terms. So we can basically buy a call option, we can sell call options, we can buy put options, and we can sell put options. So these were some trade possibilities along with options. So now let's jump over to what is basically open, what actually open implements. So basically, Open is a capital efficient DeFi option trading platform. You can basically trade your options in this particular platform. It utilizes the convexity protocol and allow user to buy and sell and create their options as a ERC20 token. So basically, you can head over to Open platform and you can basically implement your option contract as a ERC20 token. And basically, user rely on this Open hedging basically again a financial term which means basically or ensuring a particular financial risk. Basically, suppose you are having a particular token and if and you're predicting that this particular token will have a particular price and you are basically hedging your risk against that particular risk. So basically you can basically implement your option contract as a ERC20 token.
Is he audible?
Yeah. Is it just me or
Yeah, I can't hear.
Tanshu? We can't hear you.
Oh, can you hear me now?
Yeah, we can hear you.
Okay. So anybody please let me know where did I stop?
After convexity protocol, basically, you said that ERC20,
Okay.
essentially third point, I guess.
Yeah, okay, sure. So basically, user can use this particular open platform to hedge themselves against the DeFi risk. So DeFi risk includes suppose you are holding a particular token and you're predicting that this particular token might get crashed in the predicted future. So basically, you can buy a corresponding put contract which allowed you to buy that which will allow you to sell that particular token at a specified time during a specified time period. So basically, for this particular thing, open platform is basically used. So now let's move on to So now let's try to understand what actually is convexity protocol. As we heard that Open implement convexity protocol for its ERC20 exchanges. So let's have a look over it. So basically convexity protocol is an open and permissionless protocol for option contract, basically devoted for option contracts only. And using this framework, user can mint ERC20 tokens and those ERC20 tokens are known as O tokens. User can exchange those tokens using this particular protocol. And that O token, which is made up of an option contract, comprises of this particular fields. One is underlying asset for which for which the token is made, the option price, the price of that particular token, the strike price, expiry date, and the type of option. So basically, there are two type of options available in the market: American option and European option. American options allow you to sell your underlying asset before the expiration date or on the expiration date. But on the other hand, European option contract allow you to sell your underlying asset on the expiration date itself. So basically, user can mint O token by locking up some collateral and sell the token in the open market and earn premium for selling tokens. So now let's try to understand how basically a normal user can use this particular convexity protocol via the open platform
Nitanshu, I
to
think.
hedge themselves against DeFi.
Yeah, sorry. I
Yeah, this
think.
would be my list.
All right. Just can finish it up.
Yeah. So basically, suppose we have two user Adam and Shadam. I just kept their name funny, intended actually. So basically, Adam has around 1,000 DAI and is currently worth 1,000 USD, but he is predicting that the 1,000 DAI will go to 800 USDs. And on the other hand, Shadam has minted a no token known as ODAI, and ODAI provocates that it will pay 99 cents for each DAI token. So to hedge against this particular DAI token risk, Adam what can actually do is buy bought ODAI token for $50 from Shadam, and when the price of the particular DAI token went to 800 USD, so now basically Adam has the basically ODAI token, so he can sell his 1,000 DAI for $990 to Shadam and can easily reduce his losses. And the corresponding use cases I got regarding the open protocol is basically user can use this protocol to hedge their tokens against a significant drop. And basically, as we know, as most of you had used compound protocol, like whenever we deposit some asset in the compound protocol, it gives us C tokens. Now, suppose in case of any flash or in case of any crisis, when those C tokens are not redeemable, so you can buy the corresponding put contracts for those C tokens, and you can basically ensure your losses.
Awesome. Yeah.
And for the improvement in open,
Dhanju, maybe you can share the PPT later. Sorry, I just
yeah, sure,
realized
sure.
there's
Yeah,
another
this is the
call
last
at
one.
8:30, right? So we
Yeah, no
probably
problem, no
won't be
problem.
able to wrap this. So what I'm gonna
No,
do is I'm just gonna give everybody 5 minutes, right? And I'm gonna give a heads up on minute 4, so that you can start wrapping up the presentation if it's exceeding your time limit.
sure.
So
Yeah,
yeah,
actually, my presentation got over. Yeah,
yeah. Uh,
no problem.
Thanks. Kundan, can you go ahead?
Yeah, yeah. Can you hear me?
Yeah.
Let me share my screen.
Your screen though.
Wait.
Hello.
Yeah, yeah. Uh, can you see the screen?
Yeah.
Yeah. So my research topic was Aave protocol. Aave protocol, also known as liquid money market. Uh, so let's start by a little history of Aave protocol. Started in Finland in 2017. The initial name was Ethland, and 2018 it was renamed as Aave, which means ghost in Finnish language. The founder was named as Stani Kulichev. On our protocol, there are two possibilities. You can either be a depositor or a borrower. So the role of depositor is to provide liquidity for the protocol, and the role of borrowers is to take loans, over collateralized loans or under collateralized loan. Let's see a little bit of the tokenomics on Aave platform. So the native token is known as Aave, which is an ERC 20 standard token. The stakeholders of Aave protocol can contribute to the protocol in different manner. The stakeholders who hold the Aave token, they can contribute as a technical contribution, or like for example some technical features, adding some technical feature, or like in part financial participation, they can add liquidity to the protocol. So when the user provides liquidity on Aave, they get A tokens, and these A tokens are pegged to 1:1 ratio to the underlying asset that they deposit to the Aave protocol. So Aave protocol mainly provides lending and borrowing. So for every specific
Yeah. I can't hear you. Hello.
Yeah, we can hear you, Shlok.
Yeah, but can you all hear Kundan? No.
No, we can.
No. Okay. Um, mm, Kundan, we can't hear you. Let's move ahead with the next presentation, I think. Since we're anyway short of time.
Can I go ahead?
I think after this is in Mahika and then it's
Yeah,
Sure.
Mahika.
I'll present.
Yeah, sure.
Yeah, is my screen visible? Oh, yeah, is my screen visible?
Yes.
Yeah, okay. So, as we were seeing before, that Aave was a famous lending and borrowing protocol. So, today I am going to talk about beta finance, which adds a third dimension to this permissionless money market, that is shorting of crypto assets. So, let us get a quick overview of how shorting works. So suppose you think that the price of Bitcoin is going to drop. So from a decentralized exchange, you borrows a Bitcoin and then you sell it here. For example, let's say at $5,000, and then according to your prediction in the market, the price of Bitcoin actually drops. So then you buy it back again at 4,000 rupees, at $4,000, and then you repay your debt of one Bitcoin, and you get a profit of $1,000. So this is basically shorting. So it is like a counter force that tries to balance out the curve of the asset. So because you are selling your coin when the price is high, so you're increasing the supply, and you're buying back the coin when the price is low, so you're decreasing the supply. So this kind of shorting helps to balance out the curve of a asset, because we are playing opposite to how the market is working. So that is exactly the aim of beta finance, that is to offset the volatility in the market and create a more healthier and sustainable financial system. So generally, if a user wants to execute shorting, so he'll have to firstly borrow some token from Compound and then go to a decentralized exchange and then swap those tokens. So this seems like a very manual and tedious process where the user has to maintain a list of what all positions he's handling and the different APIs and other things involved. So he has to interact with multiple protocols via different interfaces. So that's where beta finance comes in, where it provides a one-click shorting tool so that you can initiate a shorting position in one atomic transaction. So firstly, let's analyze how this process works. So here we are looking at shorting of uni tokens. So first we have to deposit some collateral here. Let's say we are depositing 100 USDC, and we aim to short these many uni tokens. So here this LTV is a loan to value ratio, which basically takes into consideration how volatile the uni asset is and tells you a good metric as to how much the risk of liquidation is. So once you cross this threshold, there is a high chance you'll get liquidated. So you can see if these measures are healthy and go ahead. And then you can also select a decentralized exchange. The platform itself selects one for you, getting the best deal. And so you deposit these 1,000 USDC, you get these uni tokens, which in that same transaction they get swapped in Uniswap, and you for these uni tokens you are receiving 35 USDC. So the 100 that you had given in plus these 35 that you received from the DEX, so total collateral of 135 USDC is deposited. So, and this borrow API indicates the borrow interest that you have to pay, and this is one of beta is the token of this protocol. So according to its tokenomics, everyone receives a reward when they either borrow, lend, or short tokens. So you can approve the coins, and in one single click you can execute this entire transaction. So one interesting feature I observed is beta protocol follows the isolated collateral model. So basically, whenever you are in a position where your deal is not profitable, so the only loss that you are limited to is the collateral that you had committed for that particular position, and not all your entire portfolio. So this is a good way where people can try to experiment with more volatile tokens instead of risking their entire protocol, instead of risking their entire portfolio. And second interesting observation was that this protocol allows you to repay your debt and collateral. So here we saw that we had shorted uni tokens, but we have also the option to pay the debt back in USDC. So on its own, the protocol will go to some decentralized exchange, and it will get back the uni tokens, and the remaining collateral will be sent back to you. And one improvement that I observed was that this protocol currently has around $9 million dollars locked in it, which is like relatively very less compared to protocols like Aave and Compound, which have billions of dollars locked in it. So other than having this one click tool for shorting assets only on the beta protocol, they could maybe try to make it more compatible to be used with money markets on these bigger platforms as well. So yeah,
Last,
that was my
oh
presentation.
boy. I was just gonna say last 30 seconds left, bro. Awesome.
Yeah.
Thanks a lot. Anybody has any questions or awesome? Let's move to Atit. Thanks, Michael.
Hi everyone, can you see my screen? Hello, hello.
Yes,
Yeah, yeah.
yes,
Can you see my screen?
yes.
Yeah. So basically, I won't be starting with the introduction of DeFi and everything. I am hoping that everyone knows here what is pooling, DeFi, and everything is. I will come to the problems the current DeFi models have. Like I will start with Aave. Like Aave, we call it a decentralized financing solution, but it is basically using oracles, which is not so decentralized. They are using a centralized entity, oracles, to calculate their collateralized interest rates. Okay, so that make all this DeFi protocol, which are using this third-party Oracle system, means prone to attacks, manipulations attacks. Like anyone can manipulate the Oracle nodes and can manipulate the pooling structure of all these DeFi uh, uh, protocols. Second is there is no money market for long tail assets. Like basically, you can't create any pools for your own ERC20 tokens. Okay, basically all the money pooling structures there exists is basically for the stable ERC20 tokens or the tokens that are currently doing good in market, but not for any other ERC20 token that you can create. The third is, as I have already explained, reliance on external oracle leading to master manipulation, impermanent loss, and oracle attack. So this is where time swap comes. So time swap is in time swap basically you are lending to the future and borrowing from the future. So TimeSwap is the world's first fully decentralized AIM-based money market protocol, which is self-sufficient, gas efficient, and work with without the needs of oracles. Okay. TimeSwap works on a three variable AIM protocol, same as Uniswap. Uniswap a two variable AIM means constant product AIM. So it is same as Uniswap, but it is using AIM model to calculate the collateralized loans. It provides a flexibility to the end user by allowing the user to decide their risk profiling and accordingly set their interest rate and collateral for each lending and borrowing transaction. It makes TimeSwap quite gas efficient, permissionless, and allow anybody to create money market for any ERC20 tokens. There are five core principles on which TimeSwap works. First is it is oracle-less. As I already explained, TimeSwap work without the need of oracle, as interest and collateral factors of the pools are determined by unique three variable constant product AM. Rather than all this oracle nodes that decide the pricing of collateral by external factors. Second is Primes is quite permissionless, as Primes allow all anybody to create an ERC20 token pool for to create this market exchange. The third is TimeSafe is non-liquidatable loans. Non-liquidatable loans means TimeSafe takes away the complexity for borrowers to constantly manage their health factor for the loans, as we do in the current traditional finance market. Borrowers have the opportunity to pay back their debt anytime before the maturity. And in the event of borrower defaulting their loans, their collateral is distributed to the lender of the pool. The fourth factor is time save is market river, and time save use market river interest and collateral. So as lender borrow and liquidator providers interact with our pool, like executing the transactions
One
are
minute.
basic.
Go ahead.
Hello. Yeah. So basically, the interest rate and the collateral loans are basically derived from the current market structure of those pools rather than the external factors. Third is, as it is oracle-less, it has the minimal attack factor. So TimeSwap is using this AM factor where principal, interest, and collateral are in the AM model. Like while interacting with the pool, lenders and borrowers change the variables such that constant product is always maintained. Lending more asset into an asset pool decreases the interest rate and collateral factor, and whereas borrowing more assets from the asset pool increases the interest rate and collateral value to be locked. The third, this is the times of native token policy, where they are managing all the structuring of the finance through their different tokens. The lenders are allotted bond principal token, bond interest token, insurance principal token, and insurance interest token. Means I can't explain them in detail because of the time constraint, but I will put it in the slides. There are four potential use cases that I have found for the time swap protocol. One is debt financing
Your
initial
time is
bond.
up. Sorry.
Yeah, no problem. But just a thing.
Yeah.
These are the four things you guys can look into it, and if you have any questions, I can answer those. What to improve? There are these three factors. Time swap protocol need to be multi-chain. Currently, it's on Polygon only. It needs more integration libraries, and third is there should be more token pairs as a default values. Yeah,
Right.
I'm done.
Awesome. Thanks a lot.
Thank you.
Anushka,
Thank you,
you're
everyone.
up next. Yeah. Hello. Anushka there? I saw her.
Yes, I'm here.
Oh, it's your turn.
Yeah, sure. Just a second, right? I need to. Yeah, sorry. I'll present my screen and.
After that, we have Pooja, so be ready.
So is my screen visible to everyone?
Yeah.
Yeah. So today I am talking about synthetics. So yeah, let's start. So what is synthetic? Synthetic is basically a liquidity pool of synthetic assets. So if we talk about synthetic assets, they are nothing but like an artificial version of the real world assets. So it's like synthetic assets are nothing but tokenized real world assets which are put on the Ethereum blockchain. Okay, so there are multiple synthetic assets available which are termed as synths. So like fiat currencies, we have cryptocurrencies, commodities, indices, and equities. So equities are like Microsoft, Tesla, and all the big firms have their stocks listed on it. It's not exactly stocks, but okay, we'll get to that later. So now let's look at the system design. So basically, you begin by staking your SNX coins. Okay, and in exchange for the SNX coin, you get USD, which is the synthetic US dollar, and then they provide a big pool where you can do everything with those USD. Like you can buy stocks, or you can do yield farming, or you can basically swap it on Uniswap or the other protocols. So one of the biggest challenges in any DeFi system is getting liquidity issues fixed. So if a person has 100 SNX, he or she can collateralize it for USD, which is a synthetic version of USD. Okay. So for every week, now that someone has stake these SNX, so what do they get in return? So whenever they stake these tokens, weekly what happens is whatever the transactions take place and the transaction fees that is extracted from those transactions is proportionately divided amongst all the stakeholders or all the coin holders, and basically how you get rewarded by staking your SNX. So what are the advantages of the various synths that are available? So the first one is that they are censorship resistant, and the second one is that you can basically buy stocks of Tesla from anywhere in the country. So what happens here is that these stocks of Tesla, we can say synths of Tesla, are backed by chainlink price feeds. So basically whatever altercations are made in the real world Tesla stocks are replicated here itself, but it's just that they are the tokenized version of it. So because of this, apparently you can invest in Tesla by sitting anywhere in the world. This also solves for slippage, which I wasn't able to understand much how it prevents, but there was this point they emphasized on a lot, that it also solves slippage. And other than that, how does the collateral or
Last
like
1 minute left.
yeah, so just a small thing, like how are SNX basically collateralized? So what you do is you buy 400 SNX, and exchange for that you get only 100 SUSD. So it's basically like 400% over collateralization you have to follow. And in case you want to be eligible for the weekly rewards, you will have to maintain that collateralization ratio of 400. Otherwise, you won't get the weekly rewards that are being offered. And basically, the SNX token is inflammatory in like in nature. So basically you can stake tokens and you can get rewards. So that's basically how synthetics work. That would be it. I've mentioned some more information here, so in case anyone wants to look, you can look at that.
Awesome. Thanks a lot. I think Pooja, you're up next. Hello, are you here?
Yes, yes.
Yeah, okay. You can start presenting.
Okay. So is my screen visible?
Yes.
Okay. So hello everyone. I am Pooja, and today's my topic for presentation was Yen Finance. So it's basically simplifying the yield farming. So basically, Yen Finance is an Ethereum-based DeFi protocol that provides services such as yield farming, lending, and insurance. This platform is an automation tool that invests into liquidity pools of various projects to deliver the best possible profits. So this protocol is basically maintained and developed by various independent contributors within the cryptocurrency space, and the management of the protocol is governed by the Wi-Fi holders. So Wi-Fi is basically the native token of yield finance. And some history about the Yen Finance. So it was launched by a South African entrepreneur and software developer Andre Cronje, and basically he developed this idea as he was tired of examining and comparing various DeFi protocols to guess the best API for his funds, and he started looking to automate his strategy for choosing the highest playing lending protocol, and we have got what we have today as Yield Finance. So, what is Wi-Fi token? It is the governance token of Yen Finance protocol launched in June 2020. It can be used to vote for changes and other decisions in the protocol and its products. And the users who lock their assets in Yen Finance get Wi-Fi tokens as rewards. And the Wi-Fi tokens have increased in values since they are very limited in supply. Only about 36,000 Wi-Fi tokens are in supply today. So, but there is a high demand, hence their price has increased drastically from $6 to about $30,000 per token. So how does CN Finance work? The API increasing protocol moves crypto assets from one decentralized lending protocol to another, and thereby allowing users to maximize their returns. The Wi-Fi contracts deployed on the Ethereum blockchain monitor the funds to connect on the connected excess to ensure that they remain in the liquidity pools that offer the most profitable yield for the funds of the user. So, Yen Finance is basically a collection of products, and Earn, APY, Vault, Zap cover as a few products which are included in the Yen Finance package. So what is Earn? So Earn is a lending aggregator that strives for the highest yield for the supported currencies like DAI, USDC, etc. So for example, it works as, for example, if a user wants to invest 500 DAI tokens, after giving tokens to earn, the protocol issues and returns Y tokens. So the user gets 500 YDAI tokens, and then the protocol moves these tokens to different lending protocols to get the maximum yield. Let's suppose compound gives maximum yield at a particular time, then divide dx, then the protocol would automatically move the funds to compound. Meanwhile, the user can claim their DAI tokens back anytime by returning the YDAI tokens to the protocol and paying a 0.5% withdrawal fee. So what is APY? APY is basically a data table that shows the interest rate across different lending protocol, and it offers users a place where they can compare the API of different dexes. So what are Yearn vaults? Yearn vaults are basically the most important product in the Yearn Finance, and they are capital pools that automatically generate yield based on opportunities present in the market. So are benefit Vault benefit users by socializing gas cost, automating the yield generation and rebalancing process, and automatically shifting capital as opportunity arises. So they are basically a group of strategies that are automatically executed on the protocol, and this is a basically a vault section of the Yearn protocol which displays the current interest rate and funds of each vault. So Yen vaults are strategies in vaults, and these strategies are developed by the token holders where the voting takes place. And buy vaults put the users deposit to work on different DeFi protocols such as providing liquidity to DEXs or providing collateral for loans. So these vaults eliminate the high gas fees of
Last
transaction.
1 minute left.
Yes, sir. Of transacting on Ethereum for the pool, as only a single account pays fees rather than every individual user paying the fees. So are all the funds in Vivolt put in a strategy? So basically, no. Some of the funds are put in the active strategy, and a very less percent are there in the vault holdings. So when a user withdraws from a vault, the fund first come from the idle portion of the vault, which has no withdrawal fees. But withdrawing from the strategy funds leads to a 0.5% fee. So this is basically a vault strategy known as the Yearn ETH vault, and when the user deposits the ETH is lent at MakerDAO as a collateral, and the collateral is used to borrow DAI. The borrowed DAI is further deposited to the buy DAI vault, and the further and more interest is generated. So it is basically a group of strategies as how the vault functions. And Zap is
Awesome.
another product in the Yen Finance. So
Yeah,
it
we done.
basically bundles. Yes, sir. I will just wrap it up. So
Okay.
it basically bundles several trades in a single click and saving users lot of cost and labors. And Yearn Labs and Iron Bags are another products, other products of the Yearn.finance protocol. And just that's it. This is my end of presentation. Thank you.
Thanks a lot. Rupali, you're up next. Are you?
Hello everyone. Is my screen visible?
Yeah.
Yeah, so my topic is MakerDAO, and as Pooja discussed, that MakerDAO allows you to basically borrow DAI tokens. So DAI stablecoins were created by MakerDAO only, and they basically lock Ethereum at their smart contract and provide you DAI stablecoin as a borrowing stuff, and Ether basically act as a collateral in the system. Now, basically, MakerDAI, what it does is it takes the Ethereum from the user, and instead of Ethereum, they mint some DAI tokens for the collateral which you have locked, and that particular DAI token will be provided to the user, which user then can use in Yen Finance or any other DeFi application to make more money or do anything with that. And whenever you have to repay the loan, you basically have to return the DAI token and some fees amount, and then your collateral, which is Ethereum, will be given back to you. So basically, Maker protocol has two tokenomics. One is collateral backed DAI token, and the second one is protocol governance token, which is MKR. So in MakerDAO, there are two tokens. One is DAI stablecoin, and the second one is MKR tokens. So DAI, we have understood that okay, we borrow DAI from the MakerDAO, and this MKR basically helps to regulate the DAI tokens. So MKR is a token which will be helping you, like if you are holding MKR tokens, then you would be helping the DAI token to become more stable, because whenever there is a proposal regarding the DAI token changes, like anything that you want to change into the MakerDAO, you basically use your MKR token to vote, and then if the proposal gets the maximum votes, it will be implemented, and if the proposal doesn't gets that much amount of votes, then that particular thing would be denied or won't be applicable on the application. Now, there are two main use cases of MakerDAO. One is crypto lending, and the second one is the tokenomics. So basically, if you are using a MakerDAO, you basically create DAI stablecoins in exchange of Ethereum, and that particular DAI stablecoins basically are the base of many DeFi protocols. So it actually provide you a productive base layer infrastructure for other DeFi protocols, And second, MakerDAO is very much popular for the gaming industry, as you could be creating game assets on the in like can help in creation of token based game assets. So basically you can have your DAI tokens on the game assets, and if you are growing in the your game, then your token would be also growing. And
Last minute left.
third most important thing about DAI is that it also helps the NFT artists to get incentivized, and that also in a particular stable assets. So that was all about DAO market maker DAO use cases, and there are some potential improvements which we could go on. So it's all about like in MakerDAO, any decision is based upon users, but if the user has a lot of money and have a lot of person in their favor, then they can easily manipulate the system. So that is something which we would be having a more stabilized, or we need to make that particular thing more stabilized. So thank you.
Awesome. Okay, thank you. Sorry, folks. I don't think we're gonna be able to continue more. So, who else? Roshan, I think Faisal and Abhishek, right? We can do yours tomorrow along with the other folks. We have another call at 8:30 for IPFS. Maybe everybody can take 2-3 minutes to just decompress before